What's up, YouTube? I'm Adam O'Dell, Chief Investment Strategist of moneyandmarkets.com. I'm once again joined by my research analyst, Matt Clark, and we're here for another week of Ask Adam Anything. Now, Matt sometimes gives me a preview of the questions. He didn't give me a full look into today's question, but he told me it was one question that we're going to cover today, and that it was a big ball of wax. So with that intro, Matt, I'll let you take it away.
And thank you very much. And again, if you do want to pose a question to Adam, you can. It can be stock related. It can be sector related. It could be maybe you want to ask him about his. We get a lot of pictures, a lot of questions about the picture in your background. So you want to ask that. Nothing is really off limits. So you can do that by emailing us at feedback@moneyandmarkets.com. We'll put that address right down there. We'll talk about it a couple times. But yeah, I look over these questions, on a almost daily basis, and there's a lot of great questions that are asked. And I think we both really appreciate everyone's interest in trying to get Adam's perspective on things. But this one question really struck out, and I thought, okay, I can ask this, and it is going to be a lot to unpack. But it's also going to really challenge Adam, and I really like to do both. I like something where he has to think about it, and one that it challenges him to give his perspective. So I'm going to give you the duration of the question here. There's a little bit of background, so add a little context here. And as soon as I say probably the first sentence, it's going to blow your mind, and that's great. The question comes from Mike, and Mike, thanks so much. Definitely appreciate you sending this in. But he says, I have 186 different holdings, including a few bonds. No mutual funds. Let that set in for now. 186 different holdings. Some positions are in a sub-portfolio I call speculative. I also have 21 options in play at this time. He says he subscribes to at least 24 financial newsletters, but he says that, and that's where he gets a lot of his great ideas. And he says, of course, some newsletters like yours, Adam, I value more than others, and some I've learned were a poor investment and now ignore them. Everything that he has ever read tells him that he has a ridiculously high number of positions. And in fact, it will bite him, and it could potentially lose money because he's holding so many positions. So now I'll get to the meat of his question now that you have that to unpack. If I can hang with the hassle of dealing with that many positions, which is kind of fun, he says, what's the real downside of having that many positions in this age of no or low trading fees? What do you think? And it came from Mike. So I'm going to turn that over to you and just let you run with it. That's a big one to ask.
Well, yeah, like I said, that's a big ball of wax, but I'm excited to talk about this. I mean, this is a type of puzzle, asset allocation and diversification that I love unpacking. I do a ton of research and ton of research and writing on. So short answer is 186 individual stock holdings too many? Well, I can't answer, for you, but it is a lot. It's definitely a lot. So let's start off with talking about diversification, or some people call it Di-WORSE-ification. So when you diversify, you are basically trying to find a middle ground. You're not trying to find the top performing stock in an opportunity set, but you're also at the same time, the advantage is you're not exposing yourself to just the worst performing stock in an index or opportunity set. So you kind of are looking for that middle ground. Now, diversification on the positive side, one thing I can say, great thing I can say about it is that it's been called the only free lunch in finance. And the reason that is you can add one, two, three, four, five different asset classes or stocks, and you basically can earn similar returns, but reduce the volatility of your portfolio. And that reduction in volatility not only makes it for a smoother ride and something you can stick with, but it also increases your compounded growth rate of that portfolio. So that's why it's the only free lunch. Now, that said, there's a limit to how much diversification you can actually get. Now, if you look at a concentrated active equity portfolio manager, somebody that's doing really deep dives on companies and putting together a portfolio, very concentrated portfolio, they're rarely going more than 12 to 15 stock positions. And the reason they do that is that once you get over about 30 stock positions, you are more or less a diversified portfolio. Okay. So the diversification benefit that you get above adding like the 31st or the 35th stock to your portfolio, you're not really getting that much more diversification benefit. Now, we actually were on a different podcast, and I mentioned our partner, Charles Sizemore, that this question came in and it had 186 different individual stock holdings. And his quip was, he's a closet indexer. And basically what he was getting at is that once you have 186 individual stocks in your portfolio, you might as well buy the S&P 500. You're going to be very correlated to the S&P 500. You might as well buy SPY, SPY, low trading costs, low management costs. So, and you get the whole diversified basket of stocks. So that was his quip. Now, the other thing I'll say about diversification is that there's a difference between diversification within the stock market and what I will call true diversification. So if you think about the 500 stocks in the S&P 500, you might think that you're diversified because you're diversified over 500 different stocks and they're all going to, be driven by different things. Well, that's really not the case. I mean, the correlation among stocks in the S&P 500 is very high during like the best of times when the bull market's on and when things are going higher. And then the correlation shoots to 1 during a down market, meaning that when things start to go down, everything goes down. So you really don't have that much diversification if you're only investing in stocks. So I follow an asset management firm called Resolve, and they do a ton of research on the number of basically independent bets you can get across stocks and across asset classes. And what they found is that if you put together a portfolio, even of all 10 US stock sectors, so again, you think you're diversified across all 10 stock sectors, they found that you're really only getting 1.5 independent bets, meaning that your success with that 10 sector portfolio is really tied largely to how the stock market overall is doing. What is equity beta doing? If equity beta is good, it doesn't matter that you're in 10 sectors or one sector, you're generally going to do well. They expanded that research into 38 industry groups. So again, if you invest in 38 industry groups, again, you're really only making 2.9 independent bets. So you're largely tied to how the stock market's doing and to some degree how interest rates are doing. So really, to get true diversification, I used to run a CTA, which is basically a commodity trading advisor. I ran a diversified trend following program. We traded over 35 basically futures markets in the 4 asset classes, stocks, bonds, currencies, and commodities. And if you trade upwards of 40 futures markets, whether you do strategic asset allocation where they're always on, or whether you do tactical trend following where you're long or short, then suddenly you can increase the number of independent bets you get from 1 or 2 if you're only investing in stocks to between 10 and 13 independent bets. And again, this is for a longer term portfolio. So if you're in positions for a longer period of time. So obviously getting 13 independent uncorrelated bets gives you truer diversification than if you just have 2 or 3 independent bets because you are a stock centric portfolio. Now, this gentleman says that he also has some bonds in there and he also has some options plays in there. So he probably has more diversification than you would assume basically looking at his 186 stock positions. But that's one piece of advice I would give as look outside the stock market, look at bonds, look at commodities, look at currencies, look at tactical ways to make independent bets. And don't assume that if you're invested in 30 or more stocks or in 500 stocks, that you are truly diversified. 2 more points I want to make on this, and because this gentleman says that if he can hang with the hassle of dealing with this many positions, which is kind of fun, he says, what's the real downside? Well, being this diversified, being over diversified, it doesn't really guarantee that you're going to lose money, as this gentleman suggests. You're not necessarily going to lose money. You're just going to be very close to the broad market's return. And then you have to think about fees and taxes. Okay. So if you're trading a lot, you're generating, I know that there aren't commissions right now, but you're still maybe paying the bid-ask spread if you're not using smart limit orders. And there's basically a cost in that, and then the tax efficiency of it if you're doing short-term gains. So at the end of the day, you have to realize that even though it's kind of fun for Mike, you have to think about the cost of managing this large and complicated of a portfolio. Now, if you enjoy doing that, then you're getting some emotional and psychological and entertainment benefit from that. Then consider the reduction in your returns relative to buying SPY, basically what you pay for the entertainment of doing that. And that's perfectly fine. You can make that decision. On the other side of the coin, if you're trying to maximize your return on time, basically the amount of time that you spend earning whatever return you earn from your investment portfolio, then you do need to consider your opportunity cost. So if you're spending hours and hours and hours managing this portfolio, and you could be spending those hours otherwise working a job, a second job, a side hustle, and earning $50, $100, $150, $200 per hour, then you probably aren't making that type of hourly rate by managing that large of a portfolio and outperforming the market that strongly. So that's just something to consider. I can't answer that question for this gentleman, whether he enjoys it enough to pay for the entertainment or whether he's trying to maximize his return on time. That's just one way that I would look at it. The final thought I want to leave everybody with is the idea of independent bets. Is different whether you are a long-term buy and hold investor versus a short-term, I'll say, trader. Okay. So when you're holding a long-term portfolio, if you only hold stocks, you have about 2 independent bets in there. If you hold 12 global asset classes, you have about 5 independent bets. If you're willing to trade upwards of 40 futures markets, you're going to get 10 to 13 independent bets. But that's about as good as you can do with a longer-term oriented portfolio. Now, the way that you can increase the number of independent bets that you expose yourself to over the course of a year, say, is to make shorter term trades. So just for an example, let's say that you buy something on Monday and you always sell it on Friday. That is an independent bet. The following week, week number 2, you do the same thing. Maybe you pick a different stock or a different sector or a different asset class. You buy something on Monday, you sell it on Friday. That is your second independent bet of the year. You do that week 3, week 4, so on and so forth. If you do that for 52 consecutive weeks, then you have made 52 independent bets throughout the course of that year. Some of them are not going to go your way. You're going to get caught wrong-footed in the market. Some of them are going to go your way. But the point is you are diversifying across time because you're making independent bets over a short period of time. And then if you take a loss, you take the loss and move on. If you have a profit, you take the profit and move on. And you are basically rolling your capital across many more independent bets than you ever could get if you just traded a long-term portfolio and bought all 40 futures markets and got 13 independent bets. So related to that, I run a shorter term, it's really a medium term swing trading options trading service. It's called Home Run Profits. We basically try to find market beating trends across all asset classes, no matter whether it's a stock sector or a commodity market or a currency or a bond market. So we're basically looking for the maximum number of independent bets over a 2 to 3 month time period. So we're holding 5 to 6 options positions, long calls at a time, and we're rotating in and out of those, basically holding each one for 2 to 3 months, sometimes longer if we catch a real runner. So that's Home Run Profits. I'm also we're beta testing right now internally an options trading service where every single Monday afternoon, I recommend 3 options trades, and we hold them for 2 trading days. So we always get out of them on Wednesday afternoon. So we hold for 2 trading days, basically 48 hours, 3 trades. So that's 3 independent bets. Although they're somewhat correlated, but we're doing this every single week. So again, we're getting well more than 50 independent bets in the course of a year. And that's a great way to add diversification. It's not going to be correlated to a long-term buy and hold portfolio, no matter how you do it. And that's another great way to get some diversification. So Mike, thank you so much for this question this week. That was a big ball of wax. Hopefully, if I did my job, I left you with some information, but probably more questions than answers. I don't want to answer specifically for your situation, but I hope I gave you some food for thought. And thanks so much for the great question.
2 things I look at this question. One is 186 holdings. I can't imagine what that brokerage screen looks like, whatever Mike uses. And then 2, I also found it interesting that in one of his statements is that if I can hang with the hassle of dealing with that many positions, so automatically already acknowledging the fact that it is a hassle to deal with that many positions, and just kind of questioning whether he can deal with it. But Adam, great information. This was a big question to ask. Had a lot of moving parts to it. And I think it was a great way to provide some great information to anyone, whether you are maybe looking at figuring out what diversification means, or maybe you're like Mike and you're in a good solid basket of positions. What should I be doing in terms of looking for that right diversification? I think Adam hit the nail right on the head. Again, if you do have a question for you want to ask of Adam, would love to do that. Just make sure that you email us at feedback@moneyandmarkets.com, right down below there, feedback@moneyandmarkets.com. If you want to provide a little bit of context in terms of what the question means, that's great. And I love to do that. I look through those all the time and love all the questions that we get. There's not been a bad one yet. And I don't think there's going to be, because you guys are doing a great job. So make sure you do that. Check out our YouTube channel. You're on it already. If you're not subscribed, make sure you are subscribed. Make sure you just click that subscribe button. You get alerted each and every time we put out a new video. We've got Ask Adam Anything, obviously. Charles Sizemore has Investing with Charles Sizemore, where he gives you his take on various stocks, whether they're good fits for you, buy, sell, hold. Then we have the Bull and the Bear podcast, which is kind of our anchor that we do once a week. I have Adam and Charles on, and we talk about either a couple stocks, maybe a sector, maybe something in the news, and always give some insight there. And then we have the marijuana market update, where every week I break down the cannabis market and tell you what to look for moving ahead. So a lot of stuff there, and we've got a lot more on the way. Adam talked about beta testing a new potential service. We've got a lot of things working on YouTube as well. So a lot of great things. Check out moneymarkets.com. Also, you get free, safe, smart, sound, simple, profitable investment information for your portfolio. We have a free daily e-letter you can sign up for, where you get that information sent to your inbox for free. Adam, thanks so much for taking the question, and look forward to talking to you again next week.
Thanks so much, man. I appreciate it.